1. Finance team's role in PMI planning. The finance team's responsibilities are broad and highly detailed, requiring rigorous planning and oversight. Below is a breakdown of their key functions. Financial assessment. The finance team must thoroughly evaluate both companies' financial health. This includes reviewing balance sheets, cash flow, debt levels, and potential synergies. Cost control and synergy realization. The finance team keeps a close watch on operational efficiencies and cost-saving opportunities. They actively track financial synergies, or KPIs, to ensure they are realized as planned, contributing to the overall success of the merger. System integration. The finance team helps in assessing existing financial technologies and streamlining systems to avoid redundancies. They implement financial platforms that accommodate the needs of the newly formed company. Compliance and reporting. Finance teams must ensure that financial reporting remains compliant with regulatory standards during the transition. This includes adhering to accounting rules and governance frameworks. Risk management. Mergers inherently introduce new financial risks. The finance team identifies, assesses, and mitigates these risks, ensuring the stability of the combined entity. In essence, the finance team acts as a financial steward, ensuring the deal's financial viability and maximizing its value for the acquiring company. Second finance team's value-up strategy. The finance team are instrumental in strategically enhancing the value of the combined entity post-merger. Below is an outline of the finance team's key strategies. First, financial synergies. The finance team identifies and leverages various levels of financial synergies during PMI. These include tax advantages. The merger may create opportunities for tax optimization, reducing the overall tax burden. Reduced cost of capital. With a larger operation, the finance team can reduce the cost of capital, benefiting from lower borrowing rates. Increased cash flow. The merger may result in increased cash flow, providing better funding for business operations and potentially reducing corporate debt. Second, smoothing profits. The finance team ensures a smooth profit trajectory post-merger by strategically managing one-time expenses. For instance, large IT investments are carefully allocated and justified within the merger framework. They avoid unnecessary spending by balancing investment with actual business performance improvements. 3. Benchmarks and KPIs. Benchmarking. The finance team benchmarks the new entity's finance function against industry standards. This ensures that the structure and costs align with the expected returns. KPI setting. Reviewing and revising key performance indicators, KPIs, ensures that the merged company is tracking the right metrics. It also ensures that individual business units are aligned to drive success. Fourth, customer profitability. The finance team evaluates customer profitability by conducting a detailed analysis. This allows the company to identify which customers are most valuable and which may need to be repriced or discontinued. Based on this analysis, the finance team collaborates with sales and marketing teams to increase margins and profits by targeting the most lucrative customers. This approach helps ensure the company's long-term financial health. In essence, the finance team actively seeks opportunities to create and enhance value through the merger, ensuring the combined entity's financial success and long-term growth. Third, finance team's PMI due diligence. The finance team peers into the future, anticipating integration challenges and uncovering hidden value drivers. Here are the key components. First, data review and analysis. The finance team needs to assess financial statements, including balance sheets, income statements, and cash flow projections. This helps to identify any financial risks or potential synergies that may arise post-merger. Review the target company's debt obligations and determine how they will impact the combined entity's capital structure. Analyze the working capital requirements to ensure liquidity during the integration process. Identify any outstanding tax liabilities that could affect future financial performance. Second, interviews with key stakeholders. The finance team conducts interviews with the target company's finance leadership to understand their accounting processes, financial controls, and reporting systems. Actively collaborates with other functional teams, such as IT, HR, operations, to gain a holistic view of the target company and its fit with the acquirer. Gather insights into the target company's financial systems and technology infrastructure to ensure compatibility and integration readiness. 3. Outputs and PMI planning. Financial integration plan. Develop a clear plan for integrating financial systems, including general ledger, accounts payable, and payroll. This plan must outline any necessary changes to reporting structures and compliance standards. Synergy realization. Identify specific financial synergies and set KPI to measure their realization. This involves tracking cost reductions, revenue enhancements, and operational efficiencies. Risk management. Produce a comprehensive risk management plan that addresses potential financial risks uncovered during due diligence. This includes mitigating tax risks, managing debt, and addressing any liquidity issues. PMI-focused financial due diligence empowers the finance team to proactively navigate financial complexities, ensuring a successful merger integration and a thriving combined entity. Fourth, finance team's PMI integration roadmap. The finance team follows a structured roadmap to ensure seamless financial integration, maintain liquidity, and achieve synergy targets. Day 1. Establish control over the acquired company's financial operations. This involves gaining access to bank accounts, changing signatories, and implementing new reporting and forecasting procedures. Communicate these changes to relevant teams to prevent disruptions. Ensure financial reporting adheres to the acquirer's accounting standards. Day 30. Begin aligning the financial systems of both companies. Assess any gaps and initiate data integration efforts. Set up KPI to track financial synergies like cost reductions and cash flow improvements. Start measuring performance against merger objectives. Ensure smooth merging of general ledger, accounts payable, and receivable systems. Day 100. Complete the initial integration of key financial systems, ensuring compatibility between both entities' platforms. Align budgets and financial forecasts of the combined entity, integrating cash flow projections and synergy realization. Continue monitoring KPI and adjust integration plans as needed. Day 180. Complete major system integrations and streamline financial processes. Realize initial synergies and cost savings, tracking progress against targets. Refine financial reporting and forecasting models to reflect the combined entity. Year 1. Achieve full financial integration with standardized processes and systems across the organization. Realize significant synergies and cost savings. Finalize tax and regulatory compliance in all relevant jurisdictions. Establish a robust financial risk management framework for the combined entity. Post-Year 1. Continuously monitor financial performance and identify new opportunities for value creation. Conduct regular reviews of financial processes and systems to ensure ongoing efficiency and effectiveness. Adapt to changes in the market or regulatory environment. 5. Finance Team's PMI Planning Simulation for Teladoc, Part 1. 5. Finance Team's PMI Planning Simulation for Teladoc, Part 2.